Hello. Very good evening to the people in India and very good morning to the people in the US. It's such a joy to connect with you. I know it's the last minute of the tax season, so the people who are still yet to file their tax returns, our team is working long and strong to serve you with the best of our value and expertise. Okay, so we have been getting so many queries on kids income, how the kids income will be taxed and all. So recently we had a client whom we were working with, and her kid won a spelling bee, a spell bee prize money of more than $50,000. And then we also had other clients, who had unearned income kind of interest income, and also the 529 savings plan. And I've been getting this queries, ever since the iPlan has been launched, which is very revolutionary and widely accepted as an employee benefit program also now. So it's such a joy, to answer these queries, and because children are a reward from the Lord, a good book says so, that it's a reward from the Lord. And whatever, that you as the parent are saving for the kid, I think you worked hard on that, and I believe that we should also work hard to save that hard-earned money. Okay, so I am Nanda Kumar K V, a founder and CEO of iLead Tax Group. We have iLead Tax Academy and iLead Tax LLC, as most of you know. So today I wanted to talk to you on how this kids income is taxed. Okay, I hope you like this presentation, because I have made this exclusively with the kids on. So is the income of minor kids taxable? Income of minor kids taxable. So as you watch the video, I encourage you to please like and share the video and comment us in case you have any questions, and I'll be happy to clarify that for you. So if you see here, we have titled this as is income of minor kids taxable. Now the question arises, what kind of income can kids have? What kind of income can kids have? Okay, so as you see here, there could be two categories of income. One, earned income, means any income that you get from working. Then the second one is the unearned income, meaning the income that comes from investments. Okay, now when we look at the earned income, it talks about wages, salaries, then part-time work, any income that you get from freelancing, anything that you get from self-employment, then prizes or awards, scholarships, stipends, your W2 in case they receive any W2 for the wage income, or W2G in case of any gambling winnings, or then 1099 miscellaneous in case they're getting some non-employee compensation. I mean, I can't say independent contractor, but in case they are working as a or they are getting some non-employee compensation. Of course, self-employment income will be taxed if their net earnings is more than $400 for that particular financial year. Now, when you look at the unearned income also, you see, when we talk about unearned income means, most of the investment income only. So it could be interest, dividend, capital gains, any other investment income, that you have invested. So this is the class of income that we are looking at, the different types of income, and if there's any other income also that is coming into place, it should fall into one of these categories, earned income or unearned income. Now, the question arises, what if the kid had only earned income? Earned income. So the recent taxpayer, that I was working with, one of our very close clients, so that we were working with, her friends were saying something. They said, that you should include that in your income, or the kid should file separate return. I mean, there's like multiple, opinions that were coming up. Then there were some free websites which were showing a different tax liability, and obviously, she was worried. So I thought, why not make a video on this so that it clarifies the general public at large. Now here, when you see, what if the client has only earned income? You see here, the client has only earned income. So earned income, I just told you a while ago that it talks about, all these, the salary, the employment income, or the prize money, scholarships, stipends, or any other earned income that you get by working. Now, so when you see this, if the kid is having only the earned income, so what it says, a child who has only earned income must file a return only if the total is more than the standard deduction for the year. What is that? A child must file an income tax return only if his earned income is more than the standard deduction for that year. Now, what is the standard deduction? So, for 2019, the standard deduction is 12,200. Right? Now, for 2020, the standard deduction is 12,400. So, if your child had earned income more than 12,200 or $12,400, then he needs to file a tax return. That's the first point. Next one, I think I told you this. The standard deduction for a dependent. Now, when we are saying kid, it means that most of the time the kid is a dependent. Okay. Now, the standard deduction for a dependent child is the total earned income plus $350 up to a maximum of $12,200. So it's up to you to know, what is the earned income of the kid, and then the maximum that you can claim as standard deduction is 12,200. Now here, if you see, I have given here two options. Okay, what if the kid is claimed as a dependent on parents' tax return? Now, what if the kid is not claimed as a dependent's parents' tax return? So maybe most of the times the taxpayers or clients also, what they do is they just try to Google, find some information from the free website, and then they say that I have to now include this. Okay, I claim him as a kid on my tax return, I claim him as a dependent on my tax return, and parallelly I want to include his income on my tax return, or I want to claim him as a dependent on my tax return and then file a return separately. Okay. But the point is, are you evaluating these options? I mean, if you see here, we have given two scenarios here, right? What if the kid is claimed as a dependent on the parent's tax return, and what if the kid is not claimed as a dependent on the parent's tax return? So there are two opportunities. Here. Two opportunities available for you. Now, what happens here? Now, when the kid is not being claimed as a dependent, what happens? Foremost, you cannot claim the child tax credit of $2,000, assuming he has a SSN. Okay, if he has ITN, he would get $500. That's something that we all are aware of. Now, what if the kid has been claimed as a dependent on the tax return? Then what happens? Then the standard deduction is limited. Of course, you get the child tax credit. If you have claimed the kid on the tax return, yes, you get the child tax credit, but the standard deduction might be limited. Okay, now what is that might be limited? Let's take a look at that. Okay, the standard deduction will be greater of $1,100 or the total earned income plus $350, which is restricted to $12,200. So the second point that I told you about, for 2019, the standard deduction for a dependent child is $1,100 or total earned income plus $350, which is restricted to $12,200. So the client that we worked on, we noticed that the second option was much beneficial for our client. See, if everything the AI could do it, artificial intelligence or the online portals could do it, I think there's no need for accountants. Maybe you can just build the software and start relying on it. I would encourage you, to always consult with a tax consultant, a tax advisor, an accountant. I mean, that's his job. All that he does is taxes. Maybe if you're in programming or in the business, that's your business. But for an accountant, for a tax practitioner, day in and day out, we will be talking to the clients just on the individual taxes, business taxes, incorporation, payroll, bookkeeping. Now, this is the language that we talk every day, right? So, if you're getting that for free, why not get a free consultation? Okay. iLead offers free consultation. I don't know about others, but this is our contact number, right? 530-HI iLead. 530-444-5323, right? If you have still not filed your tax return and you're looking for any help, please call our office. Our team would love to serve you, right? Okay. So these are the two options available in case the client has only, the kid has only the earned income. So you got to evaluate. So even if you are a student, okay, so the students from the iLead Tax Academy, if you're watching me, so even at your workplace, okay, when you're preparing a client's tax return, you got to evaluate in both the scenarios. What if the child is claimed as a dependent? Because client does not know the numbers, okay, but you got to know those numbers. So check what is the refund or the due if the client is claimed, the kid is claimed as a dependent. 2, when the kid is not claimed as a dependent, right? And then give what is best to the client. The next one. Now, what if the kid has only unearned income? What if the kid has only unearned income? Now, what happens here? Let's take a look at this chart, okay? This is only for 2018 and 19 people. Just remember that. What is in for 2020, I'll tell you in a while. But this is only for 2018 and 19. And as I have told you, even for amending the tax returns, you still have time. You can go to last 3 years tax returns and amend. Okay, amending the return is not illegal or against the law. Okay, so the law gives you, like, if you feel anywhere, you're watching us every week, thank you very much. So if you're learning something and you feel that, hey, I missed this out last year, maybe next year, I'll go with them. Okay, welcome, please join us. We would love to serve you. But at the same time, you can go back last 3 years. I think I told you, in case you're looking at amending the 2016 tax returns, the last day is tomorrow. That is July 15th, 2020, in case you are amending the 2016 tax returns. But 17, 18, even 19 tax returns, as you're watching these videos, these sessions, and as you're emailing me, getting some clarifications, you feel that, somewhere you missed something, you have 3 years time to go back and amend the tax returns. Okay, please write to us and we'll help you on this. See, if you have unearned income, there are two options here. One, the kids will file the tax return themselves. 2, B, that is, parents will elect to include income in their tax return, right? Two options. A, kids will file the tax return. Of course, they cannot file a joint return. And the second option that is available is the parents can make an election or a choice to include that kid's income in their tax return. Okay, what happens when the kid files the tax return on his own? Okay, now when the kid is filing the tax return on his own, okay, now this is what happens. Of course, the 1040 comes into picture, and then form 8615, that is tax for certain children who have unearned income. Mind you, this piece is talking only about unearned income. The kid has only unearned income, means only the income that he has got from investment, like interest, dividend, capital gains and all, right? Now, how does this happen? Okay, now here he will be subject to the regular tax and also 3.8% on the net investment income tax also, when he is going with form 8615, filing the tax return for himself. Now, the next one, parents will elect to include income in their tax return. So as I said, there are two options available. Either the kid can include the income or the parents can include the income. Now, when parents can include the income, they will file something called as form 8814, which shows that, the parents are making an election to report the kid's interest and dividends. Now, more income means more tax liability. So in our case, we were referring to our client. If we had to add, $53,000 or $55,000, worth prize money that the kid has earned to her income, she would go to the next slab. Her entire income right? So that will cost very dearly for the client. Now, that's one thing, that we have to evaluate when we are doing the tax return for the clients. So this may result in higher taxes, as the kids' income will now be taxed at parents' income tax rates. So that's why, so even if you are a student or a practitioner, I want you to, consider these options, evaluate the options, check what if the kid is filing the tax return, then check what if the parent is including that income. Check the outflow, what is it in both the scenarios, and then give the best to the client. Okay. Now, what happens when the kids are filing the tax return? Now, can anybody file the tax return, or are there any conditions? Yes, there are some conditions. Now, what are those conditions? Now, the kid's unearned income must be greater than $2,200. Okay. Then the kids must meet one of the following age requirements. Age requirement. The age must be, below 18, or the kid must be age 18 at the end of the year. Plus, he must not have any earned income that is more than half of his support. Or the kid must be a full-time student who is at least age 18, meaning you can say more than age 18, but less than age 24 at the end of the tax year, and the kid didn't have earned income that was more than half of his support. Okay, this may appear a little Greek and Latin to you. Let me tell you in simple terms. Okay, there are 3 age requirements. 1, if the child is below 18. Now, the second one, the child is at 18. The third one, the child is above 18 as a full-time student. Getting it? Let's take a look at this age criteria. So once again, now check where your kid is falling into. The kid was below age 18 at the end of the tax year. The kid was age 18 at the end of the tax year. So when we say at the end of the tax year, it means December 31st. By default, for the individual taxpayers, the default due date is December 31st. It has got nothing to do with the child's birthday. Okay. And the third scenario that you see here, the kid was a full-time student who is at least age 19 but below age 24 at the end of the tax year. Of course, the kid must not have earned income that is more than half of his support. Why? Because you cannot call him as your dependent again, right? Now, next one. The fourth point that you see, at least one of the kid's parents must be alive at the end of the tax year, and the kid doesn't file a joint return for the tax year. So, Bunty should not have a bubbly. Okay, let's take a look at the next one. Now, what happens when the parents elect to include this income on the tax return? Now, remember, when the parents are wanting to include the kid's income on the tax return, I think it is very, very clear that kid will not be filing any return separately, right? Is that clear, right? The first one, A, what we saw now was kid is taking the income, right? Now, the B, what we are seeing now is parents will elect to include that income on their tax return. So, the kid is not going to file any more tax return. Now, let's take a look at this. Now, when can the parent include their kid's income in their tax return? Okay, these are the conditions that needs to be satisfied. At the end of the tax year, your kid age was below 19 normally, or below 24 if he is a full-time student. Next, the kid's gross income must be less than $11,000 for the tax year. Then you had income only from interest and dividends. Mind you, we are talking only about unearned incomes, right? So only from interest and dividends. Of course, the capital gain distribution and then the Alaska Permanent Fund dividend. Now, the other conditions that you need to look into is no estimated tax payments were paid for your kid for the tax year. No estimated tax payments were made for your kid for the tax year. Now see, though it's a rule, what I have noticed, even the recent client, that I was referring to, I'm giving you, live scenarios. the child got money last year, 2019. They did not consult an accountant until July. And obviously, the estimated tax penalty was applicable. You don't pay the required taxes by December 31st, the estimated taxes will apply to you. Okay, so that's why we say that you need an accountant. I mean, kings have ministers. And if you are a king, when they say customer is a king, I think you should have a minister like us to minister, to administer your funds, right? To administer your hard-earned money. If you're a king, have a minister. Okay, now see here, no estimated taxes were made for your kid for the tax year, and then no overpayment from the previous tax year was applied to the current tax year. It means the last year refund, okay, adjusting against the current year tax liability or something like that. Okay, so what has happened? You have not paid any estimated taxes, and the last year refund is also not applied to the current year tax liability. And next it says, your kid is required to file a return if you do not make this election. I think that's clear. I think the title itself we have written that if parent is making this election, the kid won't file the tax return. In other words, the kid has to file a tax return if you are not making this election. Then, your kid must not file a joint return, no bubbly, and you are the parent qualified to make the election, or you file a joint return with the kid's other parent. Okay, we have seen two scenarios. What if the kid had earned income? What if the kid had unearned income? Now the third scenario is, what if the kid had both earned and unearned income, right? What if the kid had both earned and then unearned income? I mean, there's a wizard, a very intelligent guy, and a girl, right? A very good singer, a very good artist, wonderful IQ, right? Maybe can write wonderful programs. So we have seen, so many tech wizards, right? Kids. So now that money what they are earning as wages or compensation from their employer, right? Now that money they have invested and they're getting interest and dividend also on that, right? Maybe employer gave them some stocks or whatsoever, right? Now if they have both earned income and unearned income, now how does that get taxed? Let's see. What does the law say about it? Now it says, if a child has both earned and unearned income, he or she must file a return if the unearned income is more than $1,100, the earned income is more than $12,200, and the unearned income altogether is larger of $1,100 or total earned income plus $350, which is restricted to $12,200. I think just to put it in layman's language, if you have unearned income, I mean interest and dividend income greater than $1,100 or earned income greater than $12,200, then the standard deduction will also be limited to $12,200. You need to add the earned income plus $350. I mean, just like how we computed the standard deduction for the kids, the same thing will apply here too, right? In case you need, more understanding on this, please let us know. Now, that was for 2018 and 19. Now, what's new for 2020? Okay, let's take. Okay, see, we had something called as Secure Act that has come up, okay, with the TCJA, the Tax Cuts and Jobs Act. There's something called as Secure Act, wherein the entire, family income tax planning, a little bit here and there, it got affected. Now, let's see, what does this mean? Okay, now, the kiddie tax talks about how unearned income of kids below age 19 is taxed. Now, for ages, the kids' unearned income was taxed at parents' marginal income tax rates. However, the TCJA changed the rules from tax year 2018. Now, the Family Income Tax Planning and the Secure Act reversed the kiddie tax rules. To cut the long story short, what does this mean? The kids' unearned income will now be taxed as per estate and trust tax tables. Meaning, the unearned income up to $2,200 will be taxed at the child's tax rate, the kid's tax rate as per the estate and trust tax table, and income above 2200 will be taxed at the parent's highest tax rate. So income up to $2,200 will be taxed as per the estate and trust tax tables, and above 2200 it is the parent's highest income tax rates. So with this, the tax liability is going to increase. It will increase. Even the estate and the trust tax rates also, it's almost like 37% for a $12,000 income. So you need an accountant. You need a planner, not a filer. You need somebody who can plan your taxes. Okay, next one, we are seeing this, the pandemic relief economic impact payments, right? The stimulus tax payments. Now what happens to that? Because we know that, the government is giving $1,200 each for elders, and then kids below 17 years of age, it is $500. Now above 17 kids, they don't get anything. Now how are these payments? So what the law says is, these payments are not taxable income and do not count as unearned or earned income for parents or their children. So, my friend said I have to report that income. Okay, he's a very good friend, but he's not a knowledgeable friend. So maybe we know it a little better than him. Okay, we also care for your funds. So please don't trust the free information that comes out on Google. Please check with your tax advisor before you trust something. Then the third one, okay, Nanda, my kid's income is not that much, because you are talking, 12,200 and all. I don't think, my kid has so much income, maybe some 3,000-4,000 here and there. Okay, here and there, right? Here and there, earned income and unearned income, right? Even that, every dollar counts, right? Even that must be reported. Fine, let's take a look at this. What does this has got to say for us? Should a return be filed even if not required? Okay, now see, whenever you file the tax return, must be filed. Okay, 2020 tax return must be filed even if the earned income is less than 12,400 to claim a refund of tax withholding or to claim tax credits. This applies for anybody. So even if you are a single taxpayer, because of the current pandemic or whatsoever, you didn't had enough money. Okay, for married couple, it's like 24,400 now for 2019, and for 2018, it will be 24,800. If you got income of $22,000, but you had a withholding of $2,200, then you got to file your tax return. You can claim a refund only when you file the tax return. That is one. And then the second one is, you may have some credits, like refundable tax credits, in the sense that though your tax liability is zero or nil or low, you will still get those credits. And all that you have to do is file your income tax return. And only an accountant, a CPA or EA, enrolled agent, can tell you whether you qualify for a refundable tax credit or not, right? What are some of the credits that the kids must not miss out? Now, these are the credits that the kids must not miss out, or you must not miss out as parents when you're filing the tax return. The earned income tax credit, the additional child tax credit, then the health coverage credit, then the refundable credit in case you have paid AMT or something in the past, then the first time home buyer credit if you are one of those people who bought a home during the last recession times, right, 2008, 2009. The government gave $7,500 refundable credit, which was repayable in like 15 years. So that is something, that needs to be reported. And then the next one is adoption credit. Now, adoption credit also as good as like $14,000 plus, $14,000 plus every year. I think $14,080 something. Every year it keeps changing. At least $14,000 you get this adoption credit. And then, of course, refundable American Opportunity Tax education credit. So if you have incurred anything on the education, so remember that just because the income is below the standard deduction limits, it doesn't mean that you are not required to file the tax return. You may be required to file a tax return. You are not required to file the tax return, but you will get a refund only when you file the tax return. Not only the refund of the withholdings, but you may also get the refund of the refundable tax credits. Okay, and that is possible only when you have an open conversation with a knowledgeable tax accountant. Now, let's take a look at the next one. Okay, some special tips for the new parents. Okay, what are the special tips? Okay, for the new parents. Okay, given the current economic conditions, okay, you need to plan your money well, right? I'm not asking you to save money. You should know where to invest, okay? Where to invest rather than giving an interest-free loan to a heiress. I think you should know how to leverage the resources that you have, like us, and then plan your money well. Okay, so if you are a new parent, foremost congratulations. So if you are a new parent, you should make sure that your kid has a SSN, right? The social security number, that's the first one. And then if there are any maternity expenses, I mean medical expenses, whether it's co-pays or the maternity expenses or some attendant coming in from India, mother or mother-in-law, usually they come, right? The health insurance, the travel, all that, the medical care expenses, the medical expenses, right? All that comes into it. Unfortunately, current, situation also, if there are any medical expenses that you have incurred, you can claim that, but only if they are more than 7.5% of your adjusted gross income. I mean, just because you got a fever or cold or something else, the government is not going to give you a deduction for all the expenses that you incurred. The expenses that you incurred must be more than 7.5% of your annual gross income, right? And only that excess will be allowed. Next one, the child tax credit is something that you must not miss out. It will be up to $2,000 as long as the kid is below 17 years of age. And in case the kid does not have a SSN, he has only ITIN, he will get only $500. Next one is child and dependent care expenses credit, which is until 13 years of age. So in case both you and your wife both are working, right, and you put the baby in a daycare, or you're working and she is a full-time student, she is in her education, pursuing a master's or something, or you're working and the spouse is differently abled or medically not capable of taking the care of the kids, she herself needs the support, right? So you put the baby in a daycare or something like that. Whatever expenses you incur, I mean $3,000 per qualifying child, below 13 years of age. I mean only for 2 kids, that's up to $6,000. On that you can claim the child tax credit based on the income slab that you fall into. Anywhere from 20% to 35% of the expenses that you have incurred, that can be claimed as credit for child and dependent care expenses. The next one, as I told you, adoption credit. So it's good. It's really awesome. We have clients who have done that, right? So kudos to them. You're giving a new life, right? You're giving a new life. So adoption credit is something that you must not miss out. And then this college savings plan is something that, that I wanted to recommend. It's like, opening a 529 plan for college savings. Because here what happens is not only the money grows tax free, I mean it also offers a state tax deduction. Acha, just teach that habit. You never know, I mean we have seen cases like people in Virginia, Delaware, New York, Wisconsin, I mean, there's so many states, which give a state tax deduction for you for this 529 plan. Now, it not just only it goes tax free, you also get the state tax deduction, and you never know, how fast the money multiplies there. So by the time the daughter goes to college, I think you would have made a good chunk of money. So that will help you. Okay, maybe it could be as low as $500 per month in a 529 saving plan in the name of your daughter or your son. I think that will be good. Yeah. Let us know if you need any help on that. Yeah. Google doesn't tell you all that. Now, in case you are somebody who has a nanny at home to take care of the kids, you should not forget the household employment taxes. Yeah. When I teach in the iLead Tax Academy, I say Ramu Kaka. So if you have, some Ramu Kaka or Sundaraya Tata at home, so you must not miss out, because you know how the things are, right? You have a household employee, you have to pay household employee taxes also. So nanny tax is almost the same. Yeah. And then update your form W4. I mean, see, employer will deduct tax based on the information that you give to him. So you have to make sure that you give the right information, and we help you with a free W4 planning also. So if you need any help on the tax calculation, it comes, as part of iPlan also. Yeah. So just talk to our office, and in case you have, given the current pandemic, you're kind of worried about the net take-home pay, I think you must try consulting our office. Yeah. Fine. So this is what I had in store for you people. A little disclaimer for you. Yeah. You need to check with your tax advisor before you act on whatever I have presented to you. I wish you all the very best. In case you have more questions, you can please feel free to write to me. And if you want me to make more videos too, you can write to me on Nanda Kumar K V at iLeadTax.com. Any tax videos, right? You have any topics that you are struggling with, which your accountant has never told you, never discussed, you witnessed it. So probably you can just write to me. I'm Nanda Kumar K V at iLeadTax.com. Yeah. And I'll be happy to help you. Okay. And before we close, still, we get so many queries on the iPlan, and I thought, I'll just share it once again. So iPlan, as I say always, right? It's your money, hard-earned money. Hard-earned money, and you got to plan the taxes. I mean, the client that I was referring to, the estimated tax penalty was $230, and our fees, let's say, $100. So $130, $330 there. Instead of that, you could easily enroll for a plan like this, and it becomes so easy. I mean, you save on that. It's less than the cost of a monthly Netflix subscription. So it just costs you $10 per month. We just slashed it because of the current situation. So it offers you free 2020 personal tax planning. So whether you are somebody on W2 or you're an independent contractor or a 1099 miscellaneous, it doesn't matter. We will help you on your tax planning. Anything to do with tax planning, whether you talk about IRA, HSA, FSA, your stock options, the current PPP, the COVID-19 updates, whatever. I mean, you should be in touch with your tax accountant. Okay, remember this. Wherever you are, whoever you are. I mean, even, the other tax practitioners, though, we may compete in the industry, I think they will also agree with me in affirmative that, the client must be in touch. He must be in touch. I mean, it's like examination, okay? You have to be in touch with your teacher, with your master. And we are professionals here. We are enrolled agents. And we are the federally licensed tax practitioners, highest tax credential as per the Internal Revenue Service. And this is what we study. This is what we talk day in and day out. So what's wrong in having a free consultation? Right? I think that consultation is much more worth than your Netflix, okay? So anything to do on planning, any boggling queries that you have, because when I say planning, I cannot make an exclusive list. Okay, this, okay, we provide services on all this. Okay, I can't put a list on that. There's no need. It differs from person to person. Single, married, divorced, widow. It differs. Independent contractor, business person, S Corp, C Corp, an LLC, partnership. Somebody wants bookkeeping, somebody wants payroll, somebody wants to set up a company here in India. How do you do that, right? So the planning comes there. Next one, as part of this enrollment, you get the tax filing for free. Filing anybody can do. We don't want to charge you for filing. That's something the software takes care. You give us the source document, we punch in the numbers populate. There's nothing that we are going to do there. Maybe it's a little human effort, but there's no creative effort that's required there. So for filing, it comes along with it, okay, the federal tax planning, and then the state tax filing. And then it also offers you FBAR filing, like foreign bank accounting report, which you have to file as part of FinCEN requirements, right? The Financial Criminal Enforcement Network. So in case if you have more than $10,000 outside of USA, you got to file a FBAR with the FinCEN. And then the next one is FATCA, the Foreign Account Tax Compliance Act, Form 8938 you need to file. So instead of $10,000, if you have more than $50,000, then you need to file FATCA. And then you have ITIN application. Now when we say ITIN application, it is for those people who do not have SSN. Your spouse or your dependents who do not have the SSN, it is for those people, right? And then comes the previous year tax return evaluation. So in case you have already filed your tax return, as I told you a while ago, in case you have already filed your tax return, you can go back and amend up to last 3 years tax returns. So it offers you a free check on that also, the last 3 years tax returns. And then the next one, extension filing. In case you are not able to file your tax return by April 15th or so, or by July 15th, you can apply for the extension now. And then the next one is error-free tax representation guarantee. So it's like what some charge for peace of mind guarantee. So when we are preparing your tax return, I feel we have to be responsible for your taxes. So hold us accountable for your taxes, right? So that we call it as error-free tax representation guarantee. And then finally, it is the Indian tax filing. The Indian tax filing services, Jai Bharat, right? So in case you have a tax filing requirement in India, even that piece will be taken care of, and we will also help you with the filing in the Indian geography too. Okay, so we call it as stop filing yearly and then start planning monthly, because if you fail to plan, you plan to fail. So please take care of that. Fine people, so thank you very much for joining me. This is what I had for you today. Thank you very much for joining us. If you like this video, please share this video with 3 people. Let us know what they think, and please do subscribe to our channel. And if you have more questions, if you want me to make more tax videos, please write to me. I am Nanda Kumar KV at iLeadtax.com. Thank you very, very much. See you soon in my next video. Bye-bye.